this is the best time to buy. I know there's bias sitting here from me being in a buyer's agency business. I'm just trying to tell you, buying right now, when we know certain markets are not tanking, but the sentiment will allow you to make that negotiation a bit in your favor, it won't last long.
Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Welcome back to another episode of the Property Nerds podcast. I'm your co-host, Arjun Paliwal, with Jack Fouracre from Fouracre Financial. And today, we are jumping into these post-budget behaviors that we're seeing. What are people doing? What are people responding with? What's the actual effect? Because policies have intentions, but actual outcomes can be different to intentions. So we're going to unpack some of the actual outcomes we're seeing, what owner-occupiers are doing, what investors are doing, what people are making life decisions on differently than what they were before. Because the beauty about running the operations that we run at InvestorKit Fouracre Financial is we see a lot of families. See a lot of Aussies making decisions. We see inquiries. We see strategy conversations. And what Jack and I do in that sort of helicopter view is we're able to see conversations, pick up trends, notice them across our respective businesses, whether it be property buying or finance. So we're going to share some of those trends with you so you can see what are the Aussie conversations happening, what are they thinking of, what are they trying to do, what are they not doing anymore, and no better place to start it than the world of finance. So Jack, talk to me, man. What's happening?
Well, I said it pretty early on. I feel like the budget was a bit of a nothing burger. What's happening now is, in my eyes, purely sentiment driven. But I think there's a few unintended consequences as a result of just human behavior and what people are thinking when they're trying to plan their portfolio. So I think one of the most significant ones, we'll get into the other ones that are happening, but the most significant ones is that both owner-occupiers and investors don't want to sell. So even pre-budget, the biggest thing that the reason that people didn't want to sell was the massive capital gains tax bill, right? But now it's okay, if I sell, then I rebuy, I'm not going to get that gearing benefit, that immediate gearing benefit. It's going to turn into a deferred gearing benefit. Okay,
yeah, I get you. So it's people are going, I'm going to lose some of my benefits if I'm selling stuff. I remember offline we were talking about an example of what some people are doing that's really interesting with their owner-occupied debt. And I've never seen this happen before. People are always about pay off your home loan, pay off your property, do this. But you're noticing a few people change their stance on it. What are they trying?
We're getting a lot more inquiries of clients wanting to put their owner-occupied debt on interest only because they, at some point in the future, anticipate that they're going to retain that property and buy a new owner-occupied property. So when they do that, because they purchased that property pre-budget, even though they're turning into an investment years later, that debt is going to be deductible against it, and they get that immediate benefit. So investors are being pretty savvy, but I think obviously it's a negative sentiment driven market right now, but I don't think it helps that people aren't listing their properties. Listings are down, right?
Yeah, so new listings are down on some areas. What's happening is the areas where listings are elevating also because sales volumes are declining. So it's less people are buying, so the listings sit around longer.
Right.
So when the new ones come on, it's overall there's more listings.
Makes sense.
But in what you're pointing to, I agree from owner-occupier requests for interest only. Now, all your banks can't do that. So they've got to hit up specialist banks, right, for interest only. Are you noticing a trend where lots of banks are now doing owner-occupiers to interest-only loans? Because I was always under the impression that a lot of banks like to do P&I loans for owner-occ.
Yeah.
But are you noticing you then have to move people's loans to other banks as a result?
Yeah, there are some lenders that don't like owner-occupied interest only. Or if you do it, you have to have a reason. A really common reason is that, look, my kids are 15 and 16, they're in private school. I just want to go 2 to 3 years interest only to cover the cash flow So some lenders want a reason like that, but other lenders just, don't care. So it's just dependent on the individual, what they're looking for.
Well, if you're parents out there and you're thinking of private school, I'm just here to let you know, did private school for a few years personally. My parents had no means to chuck me in private. Dad was a mechanic, mum was housewife. I swear all their money was just mortgage or rent. in private school. Like typical parents just giving their all for their kids, thinking it'll be a better decision. I was a lot naughtier in private school than I was in primary school. I can tell you that. I was a cheeky ass in private school. I just think like I came out better from the public school, if I'm honest, man.
Yeah.
I'm now a whole new world of thinking of like homeschool with the kids, but I know it's a whole side conversation. But I guess where I'm trying to go is servicing. It's a game of servicing.
Yeah.
Don't send your kids to private because it'll impact your portfolio scale, and then you'll need to change the servicing a lot in your portfolio for home. But with this interest-only conversion on owner-occs, I think there's this future thought of like it becoming a investment property.
Yeah.
There's good and bads to that. Like the good part to that is like you're spot on. If people are going to want to have the debt managed at a certain level, they don't want the debt to go lower because they need the gearing on in the future. And it's a property that gets gearing because it's purchased pre-budget, it purchased owner-occ before. And they got the 6-year CGT rule.
Yeah.
But one downside to factor in is that that's a lot of people who are going to forcefully become accidental investors.
Yeah.
Because they are now going to think from a government-led decision first.
Yeah.
They're going to build a portfolio
Yeah.
that's driven by government's decisions, making them go, oh, I want to keep this as an investment.
Yeah.
But that could be a dud property that you
100%.
shouldn't be keeping. And
only
had the
natural.
government not made this change, you would have
Yeah.
sold it and moved on.
It's only natural. Like investors are reacting to what's in front of them. Like, what do these changes mean for me? How can I take advantage of it? That's it. But realistically, all they did, I don't think there was like any major structural change. All they really did was tax you more or tax you differently. The fundamentals are all still there. All investments weighed up against the same properties still to go.
Yeah.
But can we just take a moment to call out the BS on the headlines? Like, do you just think back to COVID and think, oh, you know, they're saying the market's crashing, all this stuff, right? And we're talking about single digit price reduction. So nothing to like, it's not Armageddon. But obviously the news is going to do what they do and try to get clicks and everything like that. But my dad's, you know, he's retired now. So he sends me all these articles and he's like, he knows.
Oh, you get it too, eh? I get the WhatsApp smashed of my articles, just like, oh, check this, Arjun, check this.
He knows I'm in the business and, you know, he sends us people that we know. And he's like, oh, look at what this guy's saying. And as I'm explaining it to my dad and talking to him about it, I'm like kind of figured it out myself. And I'm like thinking, Dad, you know, it's just sentiment driven. Like really nothing changed. So I think from your view, what do you think do you think there's going to be a trigger to kind of bring back buyers and bring back activity and remove that sentiment? Is that trigger going to be, you know, reducing interest rates? Or do you think, does it always have to be a trigger? Is it just something that, you know, investors will look at it and go, oh, wow, you know, this 6 to 12 months of, you know, low listings, not a lot of rental supply, my yields, I was getting 5% yield, now I can get 7% yield on that same property. Do you think that would trigger the sentiment to shift?
Yeah, so firstly, there's the reality and then there's sentiment and then there's headlines. So when I look at the reality piece, and funny you say the dad thing, that means all dads from that generation are the same.
My dad we're in business, man.
Yeah, it's exactly. My dad, and like the funniest thing is no matter what you tell them that month, the next month they'll do it again, and they'll be like, nah, like, because like I think it's like we're their kids, so they're listening to us because they want to have a chat with us, because we're so busy.
I think they worry too.
But then they worry about us thinking, oh, what about the biz?
Yeah, sell your business. I'm like, no, we're buying businesses.
That's right. And so then they go, and then when you tell them what it is, they're like, yeah, sounds good. All right, okay, makes sense. And then just do it again next week.
Yeah.
But look, the reality is this. The reality is that when it comes to the markets, firstly, a very simple data point we do something called quartile-based review. The top of the market, the upper middle of the market, the middle of the market, the lower of the market, the lower of the market, lowest of the market.
Yeah.
And the trend's clear
that
everywhere is not super hot, but everywhere is also not declining like crazy. There are some ends of the market, the lowest end, where if you take this first quarter data post-budget and you annualize it, you could be at a -2% up to a positive 3%. So you're basically saying the sentiment's shifted so that taking that quarter result of May, June, July data into some of August, the country is largely in the lower end, either flat, slightly growing, or slightly declining. It's a whole new story on the top end.
Yeah.
If you take the top end of the market, on quarterly markets, if you annualize them, you could be going from a minus 6% up to a minus 12%. So you've got 6 to 12% declines, which is chunky, on the highest end.
Yeah, yeah.
But also people forget that the highest end market, when they go, they go like crazy too. So this is not new. What's not new in Australia is higher ends having more volatility. That's always been the case.
Yeah.
What is new is how long the lower end has outperformed in Australia for like years of data I'm looking at. I haven't seen a history like this where over the 20 plus years of data I'm observing, the lower end has been beating the higher end for this long.
Yeah, wow.
We're now up to 6 years of the lower end of the country beating the higher end.
Is that just on growth rates alone, or do they take yield into consideration?
Growth
there?
alone,
Okay.
then yield is on top,
Makes it
cherries
even
on
better.
top.
Yeah.
So I'd put it down to like more beyond the budget. I'd firstly go affordability, interest rates, changing demographics, job hubs moving, gentrification. Like people don't understand that like it's not affordability alone that makes the far western suburbs of Sydney or southwest of Sydney pop. It's actually because jobs have moved in that direction too. You don't just go, I'm going to suddenly drive out an hour and a half of work because it's cheap to buy there. People don't just make that decision there. There are new job hubs in the west of Sydney, northwest of Sydney, southwest of Sydney, where people wind back the clock 10 years ago didn't have jobs there. Now they have jobs there.
Yeah.
And so that alone is also a factor. So gentrification, demographics, interest rates, affordability for servicing, and then also looking at it from the actual sentiment. People have been looking at investing sentiment, markets more national rather than backyard.
Yeah.
So affordable investing is proper in. So you can look at that in one of two ways from the reality. Best time ever to upsize your family home in Sydney that I've ever seen in the 8 years I've been doing this. The only last time I can think of that was just as good was 2019. 2019, the market was about 12% cheaper than 2017. 2017 was the peak, and there's a couple of years of declines. Like I remember one of my mates, Ronald, if he's listening to this podcast, I reckon he is because he's a client of InvestorKit too. Can you believe this? We bought him a house on over 500 square meters of land in Campbelltown for under $550,000.
God's country, mate.
God's country. Your hood,
No,
right?
that's cheap, man.
That's cheap. House, 3 bed, 1 bath, 90.
What suburb?
Campbelltown. Campbelltown.
Yeah, nice.
Yeah, proper.
Yeah.
So 2019 with a 4 in front or low 5s in front. Mental, right? So
Up around $1 million now.
Yeah. So I mean, like, but the funniest thing is, if you just waited 2 years, you would only have average growth.
Yeah.
But that 2019 was the best point. We are in 2026 in Sydney at another 2019 inflection point. Like you could be picking up a home, go to Kellyville, northwest of Sydney. You could pick up a home that's the same as like low 2s.
Yeah. Pre-budget, we were heading there anyway.
Yeah.
Everyone was looking at Sydney and Melbourne as like, it's going to go. Right.
Yeah.
Everything was showing that. And then this like short-term sentiment hit.
Upsizers dream in Sydney. So like when you come back to your core question, which is like, bro, what's the reality?
Yeah.
The reality is that Sydney's upsizer dream right now, affordable markets, the headlines are BS. They are not getting hammered like people are saying. But there is a sentiment window for people to pick up a deal without the heat. And then the final part is what's going to shift the sentiment.
Yeah.
I would say never has there been more control that media has had on the minds of humans than I've seen in post-COVID. Post-COVID was peak media control. So you could say media shifting is the first sentiment. So Jung has this Australian Housing Fundamentals report she releases each year. It's about to go out late August. If you're watching or listening to this podcast, it might already be out now by the time we're recording this in the start of August. But I would say that new sentiment tracker, when we track that, that's one shifter. RBA changing their tune on things could be another shifter. The next shifter of sentiment could also be government policies keep getting tweaked and turned. And we're already seeing that happen. Just today, they're saying, we're having further consultation on negative gearing policies. And we realize that the divorced and deaths need some changes so they can carry on negative gearing. Of course, that's common sense stuff. But what that shows, people don't recognize to the voting group, is that shows you that they didn't think this out properly.
Yeah.
I know they're saying consultation, they didn't think it out properly. And so I think that a combination of Victorian elections in November, more and more governments showing incompetency around what they should have and shouldn't have consulted on and changed and not changed. Media, RBA, rental news on rent crises, all of these different things are little like sentiment shifts.
Yeah.
The fifth one you're noticing, bank policy changes. These are all like little sentiment uplifters.
So I mean, two things.
Yeah.
With the news and the media, they're saying that, you know, prices are declining even for the lower end of the market. You're saying the reality is that that's not the case.
Yeah,
And
I'm basically saying they're basically flat,
And I agree
or
with
some
you.
low, some increase.
And I agree with you. I think that it's no secret, it's like pretty public knowledge that the government funds the media, or they subsidize the media.
Spicy.
So they have some level of control on, you know, what's said. And the government's been very vocal about, you know, this is all about first home buyers, which is a good segue. We're going to do an episode on
Yeah, tune into the next episode. We're doing a first home buyer segment just on that
how
one.
how the budget doesn't help first home buyers,
Yeah.
basically. So like there might be an element of a bit of government propaganda out to the media saying about how it's actually declining prices, which is just causing people not wanting to buy.
Yeah.
Like, why are you going to buy a property at 95, 98% LVR in a declining market? Which is not the case, but you raise a good point. So, and then with the RBA thing, right, would they, if inflation's still going up, but I mean, forget about the employment numbers because the government's just keeps spending money and hiring in the public sector.
Yeah.
But if inflation is still going up, will they reduce rates?
So it's just a matter of time.
Well,
So,
but
yeah.
you look back at I think it was in the 90s when there was an oil shock.
Yeah.
Stagflation. They had a period where they couldn't get inflation under control. It kept going up. Economy was tanking, but they just kept increasing the rates because inflation was still going up.
Yeah.
So, I mean, I want to believe that now with all the banking resets that we've had and all the, you know, global financial crisis, I'd like to think that they've got things in place where something like that would never happen again.
Yeah.
But
Look, never say never, but I think the main thing is this. We know we're too high on rates right now. Just know it. Now, as we said before, even in these increasing rates and heightening rates, affordable markets have still been pretty well placed. But interest rates are not meant to be here.
Yeah.
Where they're at today, they're not meant to be here. I don't care about what you read on global markets, inflations, all that sort of stuff. You're not wrong by saying it could rise. You're not wrong by saying it could be here and they stick around. But the fact is, if you want to know where this market's heading from a rates perspective, you can look at the zigs and the zags, or you can zoom out. If you zoom out from 2025 to 2027, 2026 to 2028, we better be having some crazy private job creation over the next couple of years. We better be having some, you know, new industries and economies that create wage rises. Because if they don't, the only way is down.
yeah,
Because I just can't see under the Labour leadership that we have a whole bunch of innovation and private investment in this country. It's public.
yeah,
And the thing is, for sustainable long-term economic development, it's the private industry that's got to be working, and the government industry cannot be the lead.
because it's productive.
That's right.
Government funded jobs is wasteful.
And so interest rate increases, the genuine good kind, come from a strong, healthy economy that's pumping. Like, I have no fear of high interest rates. High interest rates are good for us if they're happening for the good reasons. But if they're not happening from a booming, burgeoning private investment economy, then they're just not going to be high for long. Now, I know we've talked about interest rates for a bit. We've been able to find great growth for assets and clients as portfolios because interest rates don't correlate with the whole country going up or down. We can talk about high end, lower end, different scenarios in the country. Why I'm so passionate about this interest rate conversation is that I just can't stop thinking about what I call the other side. I talk about this other side piece so often in my content, in my media, in my emails, because people aren't seeing what I'm seeing and reacting with that way. If they were, they would be creating so many sales volumes in certain areas, knowing that if they purchase now, this other side, what is they going to do to their portfolio? Here's the other side. Governments shifting and changing. whether it be complete policy, like walking backwards on policy, shifts and change from who's in power and party, don't underestimate the impact there. Number 2, interest rates being much lower. Number 3, servicing being much higher. Number 4, rental yields being much higher. Number 5, sentiment being much higher. And number 6 is jobs and economies getting strengthening through a factor of all of those things. If you look at all of those things and then you look at the poor sentiment today, this is the best time to buy. I know there's bias sitting here from me being in a buyer's agency business. Don't even use me. Just buy yourself. I'm just trying to tell you, buying right now when we know certain markets are not tanking, but the sentiment will allow you to make that negotiation a bit in your favor, it won't last long. Because the fundamentals in certain markets are so strong that the sentiment shift could rapidly be there. And if you look at this other side, governments, policies, interest rates, borrowing capacities, rents, it's blatant. It's right there.
Yeah.
It's just a matter of when, not if.
Yeah.
You can say rates go up a little bit. You can say inflation. You can say Iran. You can say this. But it's not a matter of if. It's a matter of when. And so I'd rather not risk it. And if you're of missing it out, and if your appetite is going like, oh, I can buy large prices, you have the best to gain. If you can buy property between $800K and $2 million residential, you have the best to gain. If you can't and you still want to get ahead before affordable markets get even more hot, then of course the 6 to 800 works. But the biggest gainers in 3 years from now will be the people who bought between $800K and $1 million.
Yeah.
Just because the rental yields are already juicy on them. The prices are starting to be, fading away a little bit. The deals are good, the sentiment's good, and the capacity for borrowing, if you can squeeze in there, you're in this kind of empty territory where you can pick up something, you can negotiate well, you can get a good deal, and all it'll take is that little recovery. And that market hasn't felt the love in recent years, but that market is where the magic's at, in my opinion, if you're thinking 3-year horizon. But what else are you seeing on the finance side when it comes to certain trends on just this BS headlines that you're seeing versus the reality? Obviously, you saw interest only being one.
Yeah.
What else are you seeing?
Well, I mean, lenders are just trying to, they're obviously seeing a reduction in lending overall. So they're trying to find ways to just increase what they can offer.
Of course they are.
Increase loan amounts, increase LVRs,
What policies have you been noticing?
Well, going to 95%, 98% in the non-bank space for investment.
Wow.
First and second tier lenders opening up to 40-year loan terms, still offering interest-only terms. So there's probably, we could probably do a full episode on the changes that have come in, because I actually predicted these changes way back.
You did.
A couple of days after budget night. But there are some that didn't come true, so we'll cover that as well.
Yeah. Do we want to cover that or no? We just
I got to keep me honest, mate.
Yeah, that's good. Look, the 40-year one, it's here.
Yeah,
it's here, and we're not talking like the banks that you've never heard of them. We're talking like AMP, big names.
Yeah.
And you know what's crazy about the 40-year stuff? What are they doing on the interest only? That's been interesting.
Yeah, because obviously if you do a 30-year loan term and you go 25 years P&I, 5 years interest only, they're doing the servicing based on the 25-year loan term. But if you've got a 40-year loan term and you've got 5 years interest only, well, then they're doing servicing on a 35-year P&I term. So this is just the lenders trying to adjust for the change in borrowing that has kind of pushed a lot of the market to non-bank lenders. And I even last night I was having some chats with the big banks, some of the higher up in the BDM space, or the ones that are in charge of the broker channel, and they're trying to workshop policy to try to
spark stuff.
Try to increase what they can do.
Back, right? At the end of the day, they got shareholders they report to.
Yeah.
They couldn't care about the RBA. They couldn't care about the government. The government's not their shareholder for everything. Yeah. The big banks are like, hey, we got private money globally and locally. Wanting to make sure we make a profit. And profit can come in two ways, margins or volume. And so if you've got a margin issue, where, by the way, competition will create margin issues for you. As soon as you're a bank and you've got all these other people going, hey, we want business too, there's issues going on, they'll fight for it. Now you can't win on the margin game. So how do you win? You win on volume. So if you're a big business and you go, I can't win on margin because everyone's competing for dollars, cashback offers, refis, movement to small banks offering competitive policies or competitive rates, we can't price match that. If we do, we're already getting, chewed off with RBA rates being so high, so we don't have as much to sit on. Well, they'll go the volume game. And what stuff you're talking about is all volume. It's big. Well, that is the reality of what we're seeing. Well, that is another episode on the Property Nerds where Jack's here unpacking the realities of finance trends, what he's seeing out there. And, mate, that's a really insightful take of what we're seeing, what you're seeing particularly. And that's another episode of the Property Nerds. We'll see you in the next one where the first home buyers, we're going to be unpacking what's happening there. So see you in the next episode.
The information featured in this podcast is general in nature and does not take into consideration your financial situation or individual needs and should not be relied upon. Before making any investment, insurance, tax, property or financial planning decision, you should consult a licensed professional who can advise whether your decision is appropriate for you. Guests appearing on this podcast may have a commercial relationship with the companies mentioned.
Game over.